If you're about to inherit a property or you know someone who is, listen closely, because there's a way to do this where you can keep the low tax base. And if you do it the wrong way, when you inherit that property, you might get slapped with a $30,000 tax bill. Most people don't know this, and by the time they figure it out, it's too late. In this video, I'll show you exactly how to inherit a property without getting taxed to death and how to protect generational wealth the legal way. Hi, I'm Justin Brown, mortgage pro, real estate investor, and I've been doing this a long time. So here's what you need to know. So here's what most people don't understand. When someone passes down a home, whether it's a parent, grandparent, whoever, the county could reassess the property to its current market value. So let's say your parents bought a home in 1988 for $25,000 and their property taxes today are maybe $1,000 a year or less in some cases. But now that home's worth $1.3 million. If the county reassesses your tax bill, that could jump up to a good $15,000 to $20,000 a year forever. And if you didn't plan for that, you might be forced to sell just to cover those new taxes. So in California, it used to be a lot easier to avoid that reassessment. Parents could transfer property to their kids and the tax base stayed the same, no matter what the home was worth. That was under Prop 13 and Prop 58. But in 2021, Prop 19 changed everything. Now, the only way to avoid reassessment is if, one, the property was your parents' primary residence, two, you move in within 1 year, and three, you file the proper paperwork with the county assessor. And if you miss any of those steps or don't live in the home, your taxes go up, period. So that dream of keeping the family house could turn into a nightmare pretty quick. So here's the right way to do it, where you can legally avoid the reassessment. Step one is you're going to want to make sure the home is in a revocable living trust. That avoids probate and gives you legal control instantly when the owner passes. Step two is if it's a primary residence and you're the heir, you got to move in within those 12 months. You must actually live there, not just say you do. And step three is to file the parent-child exclusion form with the county assessor. This is how you actually request to keep the lower tax base. Most people don't file or file too late, and that's when the reassessment kicks in. And then, like an optional step four, if you're transferring investment property or a second home and it's not covered under Prop 19, consider holding it in an LLC from day one. If structured correctly, this could help you transfer ownership later without triggering a reassessment. It's all about structure and timing. And another piece people forget is the mortgage doesn't disappear. If you inherit a home with a mortgage, you're now responsible for the payments. But here's the move. You just contact the mortgage company right away. You could ask them to be added as a successor in interest. This is what's going to give you access to the account. It lets you keep the loan current. It even lets you ask for a loan modification if needed. So don't wait for notices or deadlines. You got to be proactive with this. Just send them a copy of legal proof that you're the heir to the property, and then they'll add you as that successor in interest. So inheriting a property shouldn't be a blessing, but if you don't understand how the system works, it could quickly turn into a liability. The government's not going to tell you how to keep the wealth. You've got to know how to play the game. Use a trust, know the Prop 19 rules, file the right forms, and most importantly, make the move while the opportunity is still on the table. And if you want to learn more about how to protect wealth, build smart, and avoid these traps, make sure you hit that like and subscribe button, because real estate's only confusing if you're doing it alone. And that's why you follow me.